Hello, everyone. This is Sebastian McMahon from IA Financial Group, and I'm back with another weekly economic review, this time for the week ending August 27, 2021. So, look at this week's markets at the close on a Thursday. As I am recording this, the markets are not open yet. We could have some volatility today because we have a speech from Mr. Powell, the Fed chair at Jackson Hole, and we have another reading of a very important confidence survey that I'll be discussing in a few minutes, the Michigan one. But after 4 days, interest rates higher, stock market higher, Canadian dollar higher. So very positive week on many fronts, except for the bonds. Of course, if interest rates are higher, that means losses for bonds. The long index down 0.8% on the week. Year to date, we're still very much in negative territory here. The TSX this week, 0.84%. Along with the outperformers that were emerging markets, EFI and the NASDAQ. So a bit of a rebound here from the emerging markets. NASDAQ still continuing its strong growth that we've seen throughout the summer. We still see growth rebounding versus value. So this is a theme that keeps on going on. But the most interesting part is that even though the S&P 500 was strong this week, when you bring everything back in Canadian dollars because of the 1.06% gain on the CAD, that means that you have almost 1% up on the TSX and almost 0.5% down for the S&P 500. So very strong outperformance of the TSX this week when we bring everything back in Canadian dollars. Oil was up about 8% after 4 days. As I am recording this prior to market open, oil is still up about 2 point some percent, almost 3%. So we could have even a 10% week. So we'll see with everything that could go on today where we end up. But a very strong week for the price of oil. The USD CAD followed suit, 1%. Euro up, gold up. So that means headwinds for the USD this week. But there's a lot of volatility in energy and in the USD and the CAD these weeks. So these things could still be moving around. So sadly, I need to go back to talking about cases and deaths and hospitalization. So I didn't. The charts on vaccination are moving very slowly now. So I thought it would be better just bring different information here. So developed countries here's my pointer. So developed countries cases are here. So now the wave that we're seeing is already above the third wave. So the fourth wave is the second biggest one after the one that we have in at the turn of the year. For cases. For deaths, as you can see, there's a large gap between cases and deaths this time around. So we are seeing probably the impact of vaccination at play. So vaccination works when you look at the difference between cases and deaths. So that's good news. But if you look at the economy and the markets, well, you need to figure out, well, how are we going to be crowding out the hospital system, and we need to shut the economy again. So hospitalizations here, this is why I brought that. Canadian average, we're right here. So it seems that vaccination is working fine so far, or at least we're controlling the fourth wave, which is less severe here than in other places in the world like the US. But Alberta is doing less well on this front. Hospitalizations are climbing. BC's here, Canadian average, Ontario, and then Quebec. So the major provinces are having a bit of dispersion, but we are seeing enough trend for everyone. So this COVID wave is alive and well, and it remains a very real economic risk. So if you look at the US situation, so here's a chart I got from the Wall Street Journal. It's the hospitalization rates depending on whether people are unvaccinated, so they're here, or vaccinated here. So you do see that whether you are vaccinated or not, that has a very strong impact on the odds that you go to the hospital. So vaccination is working, but as we've mentioned in the previous weeks, vaccination is not uniform in the US depending on the political inclination of the state. Well, you have a lot of dispersion going on. But now it's good because in the US we have high frequency data that we can look at to measure the economic impact. So in this sense, it's great to look at this kind of thing here, the mobility index from Google. So whenever you use your smartphone here to ask the GPS to lead you from one place to another. The data starts somewhere, and they build mobility, and this is with that. And as you can see right now, whether Midwest, Northeast, West, South, we're seeing some stabilization, maybe some topping off of the mobility in the U.S., but we're not seeing the high frequency impact yet. So I mentioned a few weeks ago the reservations to restaurants through the Open Table platform were not falling yet. So it seems that the economic impact, even though people are in the hospital more than before, it's not really hitting yet on the economic side. So so far so good, but it remains a very live risk. But it is starting to impact probably confidence. And this one says the University of Michigan Consumer Sentiment Survey. We don't discuss it as often as the other one from the conference board, which is the broader one, and will be coming out next week on August 31st. And we'll see if it confirms the findings here. But we need to pay attention when a survey tells us that, well, it fell to a decade low. So consumer sentiment fell to a decade low. It was the worst fall from 1 month to another in history of the survey. So this goes all the way to 1999. So we need to pay attention. So it seems that the confidence fell or even crashed down to earth in August for U.S. consumers. And if you look at here, they're asking a lot of questions to the surveyed population. They're asking, well, the expected income in 1 year, which seems to be stable, the blue line here. Expected income in 1 or 2 years, people seem to be very bearish about their prospects for real income over the next few years. Is it because they're expecting galloping inflation or falling wages, or the possibility of losing their jobs? Well, it seems that they are very, very negative here. And when you ask those within the same survey, those that are business owners, what are the business conditions expected in 1 year? Pretty stable, but expected in 1 year, you're here. The gold line here, and compared to 1 year ago, we're still high. So confidence for now is pretty good, but looking ahead, not too good either. So you're seeing a real shift here in mentality. Is it the Delta variant? Is it the fact that many states are ending extraordinary unemployment benefits? People are losing some of their support for their income. There are many things that could go on here. Or people just looking at the economic prospects and seeing a few things like us, or seeing some risks out there. It's still up in the air. So we'll see what the conference board consumer confidence survey says next week, whether it confirms this or not. But this is a very eyebrow-raising survey here. And the impact of inflation is being felt also in this survey. And inflation, it's important for the financial markets, but it's also important for consumers because it does tend to destroy demand. So if you are expecting prices to rise too quickly, probably you'll say, well, I'll just scratch off some projects. The prices do not make sense. I will not be renovating my house like I think I did. I will not be buying those large durable goods like I thought I would. And this is exactly what we have here. So they ask, well, how are the buying conditions for large household durables? And look at how it fell quickly here, almost back to the bottom of the COVID crisis and to the recession of 2008, 2009. But there's a sub question. It says, well, how much of that is price related? Well, prices, it seems, don't make sense to some of these respondents, and expectations of more inflation are also biting into their intentions to spend more. So here you're back at you're way below. I mean, the previous low was here at the bottom of the crisis in 2009, and now you're way below that. So it seems that it is really inflation is really starting to be a demand destructor. So that's a very important thing to keep in mind. It's not just about the levels of interest rates. When we talk about inflation, it has a very real economic impact. And if people keep money into their pockets, well, that means less economic growth, and that means a headwind for everything economic related for the next few months and quarters. We are seeing a lot of the big banks in the U.S. Lowering their forecasts for the second half of this year because of the variant, because of the loss of confidence. So it has very real impacts that could at some point affect the markets. Looking to Canada now quickly, the picture 4 weeks ahead of the election for the survey. So this is an aggregated survey from CBC as of yesterday, August 26th. So what they do is that they look at multiple surveys and they build confidence intervals around the number of seats that each party could get. So you need 170 seats for a majority here. It is still a possibility that the Liberals get it, but the midpoint of the confidence interval would be similar to what we have here. Even the Liberals could be losing a few seats, the Conservatives gain a few seats. But if elections were held today, most likely we would still have a minority government led by the Liberals. So the picture is not changing that much. But the main issues here, maybe just a list since we're very early in the campaign, we'll be getting back to these each week until the election. Budget deficit, the Liberals don't have a target for balanced budget, neither does the NDP. The Conservatives look to balance the market. They don't have numbers yet, but they do say that it would be in the next decade. So don't expect a balanced budget over the next few years. When the Conservatives are saying it would take a decade. Healthcare, everyone wants to boost vaccine access. The Conservatives also want to accelerate the growth of transfer to provinces. Childcare, the Liberals and the NDP are backing the $10 a day subsidized childcare that was discussed in the previous budget. Conservatives are more about tax credit to cover about 75% of the costs of childcare. Housing, everyone wants to address affordability, both demand and supply side measures. Some were already announced. Will make sense out of all of that over the next few weeks. And carbon tax for the environment is the topic to follow. So we'll brief you every single week. We'll see what transpires on these main issues and how the surveys are moving. So back to financial markets, the S&P 500 just had its fastest rebound in history. It took only 354 days to double from the March 2020 lows. We had that in August of this month, so 354. Previous record was 540. So it's the fastest rebound ever. So not everything is always the fastest ever, the fastest crash ever, the fastest rebound ever. So this is the world that we live in. Look at how quickly the rebound operated. Some volatility, some wiggles, but very close to a straight line up compared to the one after 2009. We did have a pocket of weakness here, and typically these things used to drag on for a while. Now it's pretty much a straight line up. And if you look at it this way, well, since the bottom of April, where we had a pullback at 35% from the previous bottom, the previous peak rather, we were at minus 35%. During the summer, the end of the summer, we had recuperated everything. Then we had a few close to minus 10% pullback. We didn't get to minus 10, but close to it. And since then, it's been by the dips, and about pullbacks of 3 to 4%. Never anything that exceeded 5% since last October. And this is getting long in the tooth. I always like the stats that since World War II, you have on average every 9 months a correction of 10% or more in the market. So it's been a very long while since we've had something like that. So that's again a sign of maybe fragility, but we could always end the year without any volatility either. You cannot never time these things, but what we do know is that the buy the dip mentality is alive and well, and it helped the US market outperform very strongly other markets this summer. If you look at here, the MSCI US, so another version of the it's just similar to the S&P 500, another version of the index. Since June, we kind of diverged from the MSCI World ex-US. So it used to be that markets moved together, but this summer the US stock market did this, and the rest of the world did this. So that's an outperformance of about 10%. So we still prefer to be neutral in our positioning for equities. We prefer to be overweight Canada. We prefer to be overweight Europe and to be underweight the US because we've seen this. Of course, this summer that was a headwind for the performance of some of our funds, but still we think we're in a very healthy place to be overweight outside of the US and underweight in the US because of this gap of outperformance. We have shared many charts over the last few months about why we prefer to be neutral. It's not about being defensive or underweight. It's about being more neutral than not, taking some good profits after such a strong performance in the stock market. Now we look at how global investors are positioned. This is Bank of America private client holdings as a percentage of AUM, 65% now. We've never seen such a strong position in equities. We see that the short interest for the typical stock is extremely low at 1.5%. The last time we saw something like this was at the peak of the dot-com bubble. So it means that everyone's kind of afraid of shorting a stock because everything goes up, so you don't want to lose your shirt on the shorting stocks. So we're many signs of strong risk appetite that are there, and for us we think that it's not that we're doom and gloom, but when we see that, so well, maybe it's a good time to be taking some profits and wait it out to have either a good entry point or more clarity on where we stand in the market here. So looking also at interest rates, finally, the trend has been lower interest rates for 13 years now, since 2008. The bottom was at the bottom of the COVID crisis here for North American interest rates. We did have a bit of a rebound earlier, well, not late last year and early this year. We had the market, just like us, was expecting stronger growth, stronger inflation, so that means higher interest rates. But now we're starting to see interest rates go back down again. So you're starting to see that here. So you're starting to see global investors in bonds being more careful, saying, all right, maybe everything is not as rosy as we thought. Maybe growth is not as resilient as we might have thought. So that pushed interest rates a bit higher. And we can see that in the chart here, which is a very interesting one. You all know about the VIX, the volatility index for stocks, which is also called the fear index. So when the VIX is elevated, that means that there's fear in the stock market. And when it's down, when it's lower, that means there's less fear in the stock market. So now we're at the post-COVID low here for stocks, but there's the equivalent index for bonds. They call it the MOVE index. We don't present it often, but it's the pink line here. As you can see, we are pretty much as we see as much fear in the bond market now as we did in March or of April of 2020, March 2021, and now pretty much similar levels. So either one of of these is wrong. Either there's not enough fear in the stock market, there's too much fear, or in the bond market, then you should have at some point converge somewhere down the road. So if we do have economic data that starts to falter, will we see fear gain the stock market, or if we have if things work out well in the end, will we have less fear in the bond market and see interest rates rise again as people are less keen to be holding bonds for protection? So very interesting questions to ask. We don't have the reason, the answer yet, but we do prefer to, again, have a bit of a more neutral positioning in this kind of environment. We remain slightly underweight bonds, but we have reduced this underweight over the last couple of months. So next week, we'll have very important data points. We'll have GDP in Canada for June. In May, it was negative. In June, it should be a bit positive. For Q2, we should have now we will have all months, so it should be about 2.5% annualized, less than in the US. In the US, it was 6.5, but we do expect the second half of this year to be stronger in Canada than in the US because we did go through some closing of the economy again in Q2, and now we are more reopening. Vaccination has been doing better here than in the States, so we should be seeing some outperformance from now on. Building permits also in Canada in June, they were higher. In the US, we'll have the very important confidence index that I mentioned earlier, the conference board one. I didn't include it here because I needed space for the ISM manufacturing and services indices. Should be close to 60 for both, so which is very, very strong. So we're slowing down from very elevated levels, but steadily slowing down. The non-farm payroll, so the jobs report, 769,000 is expected. Last month, it was close to 1 million. It was 950. But we could start to see here the early impacts of the Delta variant. So very important report next week. And the unemployment rate should be lower at 5.2% in August. So that wraps it up for this week. If you want to reach us, ia.ca/economy, you'll find everything that we produce there. And if you want a copy of this PDF presentation, you can always write at economics@ia.ca. It'll be our pleasure to send it to you. So again, thank you everyone for your support, and we'll be back next Friday with another edition of the Weekly Economic Review.